EPK Capital presents Daily Brief, 18 September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your AI host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Executive Summary, the main event and the mixed signal. Today's financial landscape was dominated by a powerful 1-2 punch from the U.S. Federal Reserve. The first, a long-anticipated interest rate cut, was a clear signal of monetary easing. The second, a cautious and at times conflicting message from Fed Chair Jerome Powell, introduced a significant layer of nuance and uncertainty. This dynamic sent U.S. stocks on a late-day roller coaster ride, ultimately leading to a bifurcated market close. The blue-chip Dow Jones Industrial Average finished firmly in the green, while the technology-heavy Nasdaq and the broader S&P 500 slipped into the red. Beyond the Fed's sphere of influence, significant developments unfolded in global markets. India's underperformance became a standout story, with its equity market grappling with a major valuation-earnings mismatch. At the same time, the cryptocurrency space witnessed a landmark regulatory shift that could pave the way for a new era of mainstream adoption. This report will unpack these events, providing a detailed analysis of the underlying forces that shaped today's financial headlines. The Global Scorecard: How Major Indices Fared. To understand the day's events, it is essential to first establish a baseline of market performance. Today's trading session was characterized by a mixed bag of results, reflecting the complex crosscurrents at play. In the United States, the S&P 500 closed at 6,635, down 641 points, or 0.1%. The index spent the day churning between gains and losses, ultimately finishing near the record levels it had set earlier in the week. The Dow Jones Industrial Average, however, showed remarkable resilience, rising 260.42 points, or 0.6%, to close at 46,018.32. In contrast, the technology-focused Nasdaq Composite fell 72.63 points, or 0.3%, to 22,261.33. A similar trend was observed in the Russell 2000 index of smaller companies, which managed a modest gain of 4.31 points, or 0.2%, to close at 2,407.34. This divergence between the Dow and the other major indices is not a random occurrence. It is a direct reflection of investor psychology and market structure. The Nasdaq is heavily weighted toward growth and technology stocks, which are particularly sensitive to both interest rates and shifts in investor risk appetite. The Dow, by contrast, is a price-weighted index of 30 blue-chip companies, many of which are more established and operate in cyclical sectors. When Jerome Powell's cautious tone introduced a layer of uncertainty, the market's initial risk-on sentiment, which had lifted all stocks earlier in the session, began to fade. This led investors to differentiate. They moved away from riskier, high-beta growth stocks, causing the Nasdaq and the broader S&P 500 to slip, while simultaneously moving into perceived safer, dividend-paying blue chips, which boosted the Dow. This selective flight to quality highlights a deeper layer of market anxiety, where a seemingly straightforward positive event, a rate cut, was reinterpreted as a potential sign of underlying economic fragility. Internationally, the market's response to the Fed's move was more uniform and generally positive. The FTSE 100 in London closed up 0.14% at 9,208.37. While Germany's DAX Performance Index rose 0.13% to 23,359.18.2. Japan's Nikkei 225 surged 1.45% to close at 45,440.65. The S&P TSX Composite Index of Canada rose 0.022% to 29,321.66. A notable exception to the generally positive global market sentiment was India. The Nifty 50 closed at 25,429.95. In a stunning reversal of fortune, the benchmark Sensex has delivered a meager 1.9% return in US dollar terms so far in 2025, branding it as the worst performer among 17 major global indices. This is in stark contrast to markets like Korea's Kospi, which has exploded 53.5%, and Germany's DAX, which has surged 36%. The Federal Reserve's unfolding story, a rate cut and a conflicted message. The centerpiece of today's market action was the conclusion of the Federal Open Market Committee (FOMC) meeting. As widely anticipated by markets, the Federal Reserve decided to lower the federal funds rate by 25 basis points. This move marks the first rate cut since December 2024, signaling a pivot toward a more accommodative monetary policy. The primary catalyst for this decision was a notable softening in the U.S. labor market. August payrolls added just 22,000 jobs, a figure well short of forecasts, and the unemployment rate climbed to 4.3%, its highest level since October 2021. This shift in employment data prompted the Fed to prioritize its employment mandate, even as inflation remains above its 2% target. While the rate cut itself was a clear signal of easing, the subsequent press conference with Chairman Jerome Powell introduced a significant layer of nuance and uncertainty that caused the late-day market volatility. Powell's commentary sought to temper market expectations and fade the dots, which were the committee's own projections for future rate moves. He emphasized that the path forward is not predetermined, but will be decided on a meeting-by-meeting basis, with high uncertainty around the projections. The market reaction was driven by what many analysts characterized as a strategically inconsistent stance from Powell. On one hand, he acknowledged that the job market has slowed and risks to employment have risen. On the other, he maintained that the Fed is still mindful toward inflation risks. He also stated that he does not believe pushing out the achievement of the 2% inflation target presents credibility problems, indicating a willingness to be patient. This balancing act between concern for the labor market and vigilance on inflation created the very kind of mixed signal that led to the Dow's rise and the S&P 500 and Nasdaq's decline. The FOMC's Summary of Economic Projections, SEP, provides a forward-looking roadmap for the committee's thinking, and a closer look at the data reveals a different story from Powell's cautious rhetoric. The median projection for the federal funds rate for 2025 is 3.6%. This figure implies that the majority of FOMC members believe the economy requires an additional 25 basis point cuts before the year's end. The median then projects further cuts to 3.4% in 2026 and 3.1% in 2027, before settling at a longer run rate of 3.0%. The economic projections are as follows. Real GDP growth is projected to be 1.6% in 2025, followed by 1.8% in 2026 and 1.9% in 2027.8. The unemployment rate is expected to rise slightly to 4.5% in 2025 before gradually declining to 4.2% in 2028 and the longer run. PCE inflation is projected to be 3.0% in 2025, eventually reaching the Fed's 2.0% target in 2028. The central tension of the day is found in the apparent contradiction between Powell's hawkish rhetoric and the dovish roadmap laid out in the dot plot. On the surface, his comments sought to temper market expectations, leading to the mixed closing. However, the underlying projections paint a different picture, suggesting that the majority of FOMC members believe the economy requires a significant, front-loaded easing cycle to avoid a deeper slowdown. This strategic contradiction serves a clear purpose: to deliver the necessary stimulus while simultaneously managing a market that tends to overreact to any sign of a dovish pivot, which could risk reigniting inflationary pressures. A deeper look. The ripple effect across markets. The Fed's decision and the ensuing market reaction were not uniform. The mixed results of the major indices were a consequence of significant divergence at the stock-specific and sector-specific level. The mixed performance of the major indices was a reflection of the significant divergence seen at the stock-specific and sector-specific level. Advancers, Hologic, Cholex. The medical technology company's shares jumped 7.7%, making it the top performer in the S&P 500. This push higher came on reports that investment firms Blackstone and TPG have reinitiated conversations with Hologic's board about a potential acquisition. Workday, WDAY. The enterprise software provider's stock surged 7.3% after activist investor Elliott Investment Management disclosed that it has accumulated a stake worth more than $2 billion in the company. Lyft, all left. The rideshare company's shares soared over 13% on news of a partnership with Waymo, Google's autonomous driving subsidiary, to launch a robotaxi service in Nashville starting next year. Decliners, Builders First Source, BLDR. The residential construction material provider fell 5.6%, which was the most of any S&P 500 stock. This decline occurred despite the Fed's rate cut, which was expected to bolster the housing market. The reason for the drop was a separate, more granular report from the National Association of Home Builders Wells Fargo Housing Market Index, which showed that home builder confidence in September remained mired at its lowest level. Uber Technologies, Uber. Shares of the rideshare giant dropped 5% in direct response to its rival Lyft's partnership with Waymo. Mohawk Industries, MHK. The flooring specialist sank 4%. The paradox of the housing market is a crucial lesson from today's events. While a rate cut is generally expected to stimulate the housing sector by making home ownership more affordable and reducing borrowing costs, a stock like Builders First Source fell the most in the S&P 500. This can be explained by a single specific data point from the National Association of Home Builders. This more granular report revealed a deeper underlying problem, a lack of confidence among home builders, which outweighed the positive macro signal from the Fed. This demonstrates that for certain sectors, micro-level sentiment and specific data releases can be more powerful drivers than broad macroeconomic policy shifts, especially in the short term. The digital frontier, major crypto moves and regulatory breakthroughs. Despite the mixed macro signals and volatility in traditional markets, the cryptocurrency space showed resilience and witnessed some significant gains, driven by its own powerful internal catalysts. The digital asset market saw positive movement, particularly among major altcoins. Bitcoin, BTC, the largest cryptocurrency, held its ground with a marginal gain of 0.02%, trading above $117,000. Ethereum, ETH, the second largest crypto, rallied 0.67% to over 4,579, snapping a 4-day losing streak. Altcoins. There were significant rallies in several altcoins, including Solana, SOL, up 3.57%, Cardano, ADA, up 2.62%, and Avalanche, AVAX, leading the pack with a jump of 8.25%. The crypto market's positive performance on a day of traditional market volatility suggests a potential decoupling or, more likely, a dominant sector-specific catalyst. Unlike the mixed reactions in stocks driven by Powell's cautious rhetoric, the crypto market was buoyed by its own positive regulatory news, which was a clear and unambiguous win for the industry. This highlights how a significant forward-looking regulatory event can overshadow broader macroeconomic uncertainty. The most significant news for the crypto space today came from a major regulatory breakthrough. The U.S. Securities and Exchange Commission, SEC, approved Grayscale's Digital Large Cap Fund, GDLC. This fund is now the first multi-crypto asset exchange-traded product, ETP, on the market, providing exposure to a basket of 5 major cryptocurrencies: Bitcoin, Ether, XRP, Solana, and Cardano. This approval coincided with an even more impactful development. The SEC also approved generic listing standards for crypto ETFs on an accelerated basis. This is a fundamental change to the regulatory landscape. The approval of Grayscale's fund is a major milestone, but the generic listing standards are the true paradigm shift. As a senior Bloomberg ETF analyst noted, the last time such standards were implemented, ETF launches tripled. This move streamlines the listing process and reduces barriers for dozens of other crypto ETFs. The implication is that the regulatory uncertainty that has long held back institutional and mainstream investment in crypto is beginning to clear. This could lead to a wave of new crypto-related investment products, allowing institutional investors and everyday retail traders to access digital assets through traditional regulated channels. This is the crucial step that moves crypto from a fringe, speculative asset to a legitimate and accessible part of the broader financial ecosystem. Conclusion: navigating the new paradigm. Today was a day of powerful pivots and underlying tensions. The U.S. Central Bank delivered a long-awaited rate cut, but the message from its leader, Jerome Powell, was one of caution and uncertainty, creating a mixed reaction across global markets. This dynamic exposed deeper truths about investor sentiment, from the divergence of U.S. indices to India's struggle with overvaluation. It also highlighted the inherent contradictions in modern monetary policy, as policymakers attempt to balance competing mandates in a complex economic environment. Simultaneously, we saw a landmark regulatory event in the crypto space, which has the potential to move digital assets from the fringes to the mainstream. This event demonstrates the growing importance of clear regulatory frameworks in driving market legitimacy and growth, and underscores how specific industry catalysts can overpower broader macroeconomic uncertainty. Looking ahead, investors will be watching for more central bank decisions, especially from the Bank of England, and parsing every word from policymakers to gauge the pace of the new easing cycle. The political pressure on the Fed and the regulatory shifts in the crypto world are long-term trends that will continue to shape the financial landscape for months and years to come. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.